Today I'm breaking down one of the easiest and most overlooked ones, the price-to-sales ratio, or just PS ratio. Alright, so what is the PS ratio? It's pretty simple. Take a company's market value, basically the current stock price times all the shares out there, and divide it by the company's total sales or revenue over the last year, so PS equals market cap divided by annual sales. But why do investors care? Well, the PS ratio shows you how much investors are willing to pay for each dollar of a company's sales. If a stock has a PS ratio of 4, that means investors are paying $4 for every $1 the company makes in sales. Now let's talk about why this matters. A low PS ratio might mean a stock is undervalued, or possibly that the business is struggling. A high PS ratio could mean people expect big growth, or maybe the stock is just expensive. But here's the key, you can't judge a stock just by its PS ratio. Always compare it to other companies in the same industry. Think about it. Tech companies usually have higher PS ratios than, say, grocery stores. That's because investors expect their sales to grow way faster. So a good or bad PS ratio really depends on what sector you're looking at. Also, keep in mind, the PS ratio ignores profits. A company might have huge sales but still be losing money. That's why the PS ratio is just one tool. It's super helpful when a company doesn't have profits yet, like some startups or fast-growing tech stocks, because other ratios like price to earnings don't work when earnings are negative. To sum it up, the price to sales ratio is a fast way to see how much the market values a company's sales. It's not perfect and it's not the only thing you should look at, but it's a solid starting point for comparing companies, especially in fast-moving industries. So next time you're checking out a stock, take a look at the PS ratio. It might just give you an edge. Thanks for watching, and I'll see you in the next one.